There are nearly 5,000 stocks available to buy on the US exchanges alone. How is anybody expected to find the best? How do you narrow down the list to invest in stocks that fit your goals and provide the best return possible? In this video, I'm sharing the exact process that I used as an equity analyst to pick stocks for portfolio managers. I'll walk you through the actual analysis I did recently in a stock that I bought for my own portfolio. We're talking investing in stocks for beginners today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, we've got a highly requested video today, probably one of the most requested on the channel, sharing my process for picking stocks, and I'm excited to get started on this one. Not only am I going to walk you through the exact process that I used to pick stocks when I worked for private wealth management as an equity analyst, I'm going to give you the chance to help develop a one-of-a-kind tool that's going to make all of this very easy. Now, this is something we've talked about in our Sunday live streams, but I've never put this process into an organized video like this. I used this process to find stocks when I worked as an equity analyst to produce double-digit returns every single year, and I know it's going to work for you. So I want to get to that process, but first I also need your input on something that I've been working on. I'm developing a spreadsheet, an automated tool that's going to use a lot of this process and find the best stocks and analyze your portfolio. It's all going to be an easy to use spreadsheet, but I need your help. What should I include in this tool? What do you want it to do that's going to help you pick stocks and analyze your portfolio? Scroll down and let me know in the comments, because I'm going to be using all your feedback to build this resource and make it available to everyone. Now, I'm talking anything from analyzing stocks to making sure that your portfolio is diversified to making recommendations. Anything you can think of that should be in this investing tool, scroll down and tell me in the comments below. Now, I'll be updating you here on the channel for when that spreadsheet tool is ready, so make sure you join the community by clicking that subscribe button. Now I want to walk you through that process that I used to pick stocks as an equity analyst and understand that there are a couple of different ways that analysts actually work in the market. The way I'll be describing is called buy side, which looks good for good stocks to buy and makes recommendations to a portfolio manager. The other type of analyst, the one most investors see on investing sites and then TV, is called the sell side. Now, these analysts usually cover a specific group of stocks, so maybe they're assigned to the tech sector and they analyze a group of 10 or so stocks in that sector. They only follow these stocks and the sector, updating their analysis, and then give this analysis away in the hopes that investors are going to trade on it and generate trading fees for their brokerage. So with buy-side analysis, though, you've got a much bigger universe of stocks you're looking at. You have to go out there and find the best investments among thousands of potential companies. Now, the way I make this easier is to look for those big universal forces that are going to move an entire sector of the economy. I'll start by first looking at the financial news sites like Bloomberg and CNBC. Here I am on Bloomberg and I'm looking for those big trends, not just news stories that are going to affect stocks for a few months, but the ones that are going to play out over decades. Now, this is really two strategies in one. First, I'm using that top-down analysis to get a feel for the overall economic picture and how that's going to be affecting stocks. Also, though, I'm looking for those long-term big trends that are going to affect stocks for years to come. Now, this is the best and the easiest strategy that you can use to consistently find stocks that are going to produce those double-digit returns, and I'm going to tell you why here. By looking for those big forces like an aging population, artificial intelligence, and new tech that's changing the way things are done, you don't need to pick the single best stock out of 5,000 companies. What you're doing is looking for those big forces in the sectors of the economy most affected. The trends that we're looking at for are going to drive profits and growth for every company in that sector, and it's going to do it for years, if not decades. Once you find that trend, and we'll look at an example of this, then you've automatically narrowed your list to a handful of stocks in that sector or even in that industry, and you can start looking for the best of breed in that space. So we can scroll through Bloomberg and look for some ideas here. We see a couple of interesting articles, one on a possible bubble in passive income and one on how the dollar strength could cause a problem for the stock market. Then we can click on over to CNBC and look for more ideas. Here's a story on the effect of the trade war on semiconductor industries, and this is really an interesting one. In the past, Chinese manufacturers have been almost completely dependent on US-made chips. Only 16% of the chips used in China are actually produced there, so you've got companies like Intel and Qualcomm make a lot of money exporting to the country. Now, China was already trying to develop its own semiconductor companies, but the recent trade war has really lit a fire under them, and the government is now aiming to produce 70% of its own chips by 2025. So this is going to be a big catalyst for change in the semi industry, especially for those US companies that were exporting to China. Now, I'm actually going to go with another trend, though, that I've been following, one that could be much bigger and drive significant change across the economy, and that's the development of self-driving cars. We've already had self-driving trucks complete coast-to-coast trips with the driver never touching the steering wheel. Tech startup Embark completed a 2,400-mile highway test from Los Angeles to Jacksonville, Florida in February. More recently, the U.S. Postal Service started testing self-driving trucks to deliver mail from Phoenix to Dallas. Automated cars and trucks are the future, and it's not as far out as you might expect. This is a change that's going to affect car manufacturers, transportation, infrastructure, lots of different industries, but the first to be affected is probably going to be trucking. Driver payroll for trucking companies is as much as a third of the operating costs for these companies. That's 30% of the company's costs that could come down very quickly over the next few years. Now, this is what you want to do when you find those big universal forces that are going to reshape the economy. Look for those sectors or the industries that are going to be affected. Now we can start to narrow our list of stock picks. So I'll go into Morningstar, or you can use just about any stock screener for this, and I'm going to narrow the list to transportation companies. Now that still leaves us with a few hundred stocks, but I can also filter this for the larger established companies that are going to have that capital to buy these fleets of self-driving cars first. So we'll set a market capitalization of at least $3 billion, and then maybe I want to filter for just domestic companies here in the United States, which leaves me with less than 24 names. Now I can sort this list by industry, and I see some of those integrated transportation and logistic companies like FedEx here, which is definitely going to be affected by this change, but I want to look at companies more narrowly focused on trucking. So we've got companies like J.B. Hunt, Knight-Swift Transportation, Old Dominion, and Schneider National. So there we've already narrowed this list from thousands of stocks on the U.S. exchanges to just a handful, and that's going to make the rest of this analysis so much easier. Again, we've already seen this trend that's developing in self-driving, and that's going to mean lower costs and higher profits for a lot of the companies in this group. So we can narrow the list down to one or two stocks, but really any company we pick from this list is going to have that advantage and could be a good investment. And that's the beauty of this strategy, using those big universal forces. It helps you narrow down the list of stocks that you need to research, and all but guarantees that you're going to get a great investment because you're starting with those sectors and the industries that already have the advantage on these trends. Now, before I look at those individual stocks in the industry or the sector, I want to back up and look at the existing stocks in my portfolio. Now, what you want to do here is make sure that you don't already have lots of money in this sector or the industry. It's okay to be investing along with these big developing forces, but you still want to be diversified so that you have investments across different sectors of the economy. So if I already had a big position, say maybe 30% of my stock portfolio in transportation companies, then maybe I would look for a different trend to invest in. At this point, maybe I don't want to put too much of my money in just one trend, just one of those big forces. Now, this is a judgment call on how sure you are of that trend, but there are lots of these big forces, so don't feel like you need to go all in on just one. I'd say never invest more than 20% of your portfolio in just one sector or industry of the economy. Find a few of these trends that are going to affect different sectors and diversify your money a little. So we can go back into Morningstar and look at these individual stocks in the group, and you can do this with any investing platform. Now, I use the data on Morningstar, but also use E-Trade and Merrill Lynch sometimes. So I'll use Knight-Swift to show you some of the points I look for to compare stocks, but understand that I'm doing this research for each company in that group, comparing them against each other. First, I'll go to the company's financial statements. Now, these are the 3 financial reports that the company puts out each quarter and annually. The balance sheet shows all the assets, which is cash and income producing things like inventory and equipment. The liabilities, which is everything that the company owes from unpaid wages to debt. And then finally, shareholders' equity, which is what's left over for investors after you remove those liabilities from the assets. The income statement gets most of the attention from investors because it shows that revenue and net income for the company. We'll look at this statement, and it's got one hugely important number that I use to compare stocks, but it's not the most important of these 3 financial statements. By far, the most important of the 3 financial statements for an equity analyst is the statement of cash flows. Now, those of you in the community are probably tired of hearing me talk about why this is, but I just want to repeat it one more time for new viewers. Management has a million little accounting tricks that they can play with, use to make income look better on the income statement. from bringing forward sales that won't actually be made for years to classifying expenses as long-term investments instead of cost of business. There are lots of accounting shenanigans that are perfectly legal but just inflate a company's earnings. The statement of cash flow shows actual cash coming in and out of the company. There are still a few accounting tricks to make these numbers look better, but it's so much harder to fudge these. So with this statement, you get a much purer view of the cash generating power of the business. So we're back here on the financial statements and click through to the statement of cash flows. Now I like to export this into a spreadsheet so I can play around with the numbers a little, but I'll just walk you through a few of the things that I look for. So the statement of cash flow shows cash from 3 different sources. The cash flow from operations is cash generated from the actual business, so that's going to be where we'll spend most of our time. There's also cash flow from investments, which is the company acquiring other businesses, investing in long-term equipment, selling pieces of its business, or investing in research and development. Now down a little further is cash flow from financing, which is the company raising money with debt or paying it down, buying back shares, or using cash to issue dividends. Now just a few things to look for on the statement of cash flows. First, you want to look at this cash from operations line. This is the single best measure on how a company generates cash for its investors, so very important here. And what you want to do is look at the trend, the growth from year to year and over time. So I'll just find the operational cash flow growth for each year here and then the annualized growth over the last 5 years. To find the growth in each year, you just divide the current year by the last one and then minus 1. And there's 2 things I'm going to do with this. First is I can compare this cash flow growth with other companies in the industry just to see which companies are growing cash faster. Second, I can compare this growth in cash flow with the reported growth in income. This is another point that we've talked about on the channel before, that difference in the growth rate in operational cash flow compared to the growth in net income reported on the income statement. Like I mentioned, there are all kinds of tricks that management uses to make its earnings or its income look better. It's harder to do that with actual cash flow. So what you're going to do, you're going to want to compare the growth rate the company is reporting in that cash flow from operations against the growth in its income. So for example, if a company is growing that actual cash flow coming into the business, if it's growing that at around 8% a year, but then we look at the income statement and see that it's reporting a much higher growth in net income, like 15 or 20% a year, we know management is using some serious accounting tricks to manipulate what it reports in earnings. It knows that net income is what most investors are going to fixate on, so it wants to artificially inflate that number as high as possible. Now, this doesn't mean that it's necessarily breaking the law, although the difference in cash flow and income growth have helped me find companies that were using some illegal accounting practices. But even if it's not illegal to inflate that net income number, it's still a red flag for these stocks. Now, you're never going to find a company reporting the exact same cash flow growth as net income, but the closer these two are, the better the quality earnings are going to be. Now, these other 2 sections of the cash flow statement, the cash the company uses for investing and debt, you don't have to spend quite as much time here. You do want to watch for the general trends in debt, so whether the company is borrowing a lot of money or repaying its debt. As a professional analyst, I used to spend a lot of time on this cash flow statement, like going blind looking at these numbers. But you can get some solid analysis done just by looking at that operational cash flow and the debt. Next, we can go to this income statement and look at some of the important numbers here. Though again, you always need to be skeptical of these numbers because there are ways to manipulate many of these. First, I'll look at this top line here, which is the company's sales or revenue. And you can again look at the year-over-year growth as well as that general trend and the annualized growth rate over a period of years. Again, this is just the current year divided by the previous and then minus 1. Now remember, all these numbers I'm looking at, I'm comparing them on 2 levels here. First, I'm looking at the general trends and the numbers for the company's history. I'm also going to be comparing these with other companies in the industry, so comparing the companies against each other to make sure I pick the best of breed in the space. Now, most of my time in the income statement is going to be looking at these operating expenses and then that operating income. So the operating expenses are just all the costs like administration, marketing, and other expenses to run that business. What you have left over after paying these is the operating income, which is all the sales minus what the company paid for supplies and then what it paid to run the business. Taking this operating income number and then dividing by the sales number at the top is going to give us that operating margin. Now that's the percentage of profit the company made on its sales, and this is one of the single most important numbers you can look at when comparing stocks. Again, most investors fixate on that net income reported lower on the income statement, but that's manipulated with the company's use of debt and a lot of accounting tricks. This operating income number is a pure measure of how the company converts sales into profits, and that operating margin is how efficient the company operates. So again, what you want to do is find the trend in this operating margin. Is the company getting more or less efficient at creating profits over the last few years? You also want to compare it against competitors. Who is the most efficient in the industry and generating the most profit out of their sales for their investors? We're narrowing our list of stocks, but still have 3 more steps to look at before we invest. First though, don't forget to tell me what you want to see in that investing spreadsheet tool that I'm developing. I need your input to make sure that this is the most thorough resource out there, so tell me what you want to see, what you want it to do in the comments below. Now we've got the numbers from the financial statements that we need. We can divide that long-term debt number owed against the shareholders' equity to find the debt to equity. Both numbers are on the balance sheet to get an idea of how much risk there is in the debt. We'll also use the cash flow numbers and the operating income to compare against other companies in the space. Now this next step is going to be a little bit more familiar to most investors, comparing a company's stock price to some of the numbers like sales and earnings. You can do this just by taking the company's price and then dividing by earnings per share or sales per share. Now, a lot of investing sites are going to calculate these for you, so it's a pretty easy match. Now again, I like Morningstar here in the Valuations tab because it shows a few of these different measures as well as the industry average for comparison. Here you can see the company's price to earnings, its price to sales, and price to cash flow measures all measures how expensive the stock is relative to its competitors. Another good resource for analyzing stocks is the company's investor relations page, and any company with publicly traded stocks is required to have this page. So we'll do a search for Knight-Swift Investor Relations here on Google. And on this page, there are a few places that I want to point out. First, if you don't get them on an investing site, you can get all the financial reports and then annual reports right here for the current and the past years. This news release page is also hugely important and actually an old analyst trick for finding financial problems. I love these news releases put out by companies because they make my job as an equity analyst so much easier. What happens is a lot of times a company is going to put out a news release about how well it's doing in some part of its finances. For example, maybe it highlights in a release that it's lowered the inventory to a certain number. Well, that's my red flag right there. Why was the inventory so high in the first place that management thinks investors saw it as a problem? Even better, what did management do to reduce that inventory? Now, did they legitimately get more sales, or are they just using some accounting tricks like granting easier credit to sell down their inventory and just hoping nobody sees that their accounts receivable number is exploding through the roof? So keep an eye on these news releases put out by the companies that you own. Look for financial items they point out and ask yourself why they're pointing this out and if they've really solved the problem or if they're just papering over it. Also here on the company's investor relations page, you can usually find some kind of presentation either for earnings releases or for investor groups. So I like to click through here and just look at management's perspective on the company. I can see some of the advantages management wants to highlight, and another trick that you can use here is comparing the presentations across different companies. What you'll see is that one company will highlight some numbers while another company might highlight a completely different set of measures. This is really your clue to comparing the two. How do the numbers each company isn't highlighting, how do those stack up against each other? From these presentations, you also get a sense for management's perspective on growth and their goals for the coming quarter and the year. Understand that you do need to be skeptical here because this is management's sales pitch to investors, but comparing different companies' presentations, you get a good sense of the numbers they don't want you to see and what to look for. Taking all these steps together from the financial statements to valuations and presentations, we can compare the companies within an industry. So we're starting with those big universal forces that are going to be driving sales in a specific sector, then narrowing it down to an industry and the companies in that theme. And finally, we can compare a few companies on these financial measures just to pick one or two from the group in which to invest. Now, after all the analysis, I actually ended up investing in Schneider National and Knight-Swift for my exposure to that self-driving theme. These companies could see a significant decrease in operating costs over the next decade, and that's going to drive strong earnings growth and cash flow. Click on the video to the right to see my 5 favorite stocks you can buy now and hold for the next 30 years. Investments I call forever stocks because they benefit from these long-term trends. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.